Australia has just set off a financial shockwave with far-reaching consequences. In a surprising departure from the norm, Fortescue, the nation's iron ore heavyweight, secured nearly $2 billion in financing not in US dollars but in Chinese yuan. The terms were exceptional, borrowing costs typically reserved for national governments, facilitated by China's two largest lenders. Only weeks later, Australia's Treasury launched its inaugural yuan-denominated bond, and the Reserve Bank discreetly shifted 25% of its foreign currency reserves into the Chinese renminbi. The IMF noted that no developed nation has ever pivoted toward Beijing's financial system at such speed. The deal, finalized in early August 2025, was a 14.2 billion yuan syndicated loan, equivalent to roughly $198 billion USD, coordinated by the Bank of China and ICBC. On August 7th, Reuters reported that this scale of yuan-based borrowing was without precedent for any Australian firm, and Fortescue managed to obtain rates nearly identical to those offered to the federal government. Bloomberg highlighted that as of August 22, Australian 5-year government bonds were yielding 3.67%, just below Fortescue's fixed rate of 3.8%. That's a crucial distinction. Governments can raise taxes or expand the money supply to meet obligations. Corporations cannot. Yet Fortescue secured terms that echoed sovereign-level lending. The company itself stated this was the most favorable cost of debt it had ever achieved. This was not a spontaneous decision, it was a calculated redirection. Back in February 2025, Fortescue executives disclosed during an earnings call that their $550 million hydrogen venture in Arizona faced mounting challenges due to shifting U.S. regulations. By July, the project was abandoned, and the company recorded a $150 million impairment. The Wall Street Journal interpreted this as a warning signal about investor confidence in American clean energy policy. Fortescue didn't just scale back, it exited the U.S. market entirely, realigning its focus toward China. That shift was logical. According to June 2025 data from Australia's Department of Industry, over 80% of Fortescue's iron ore exports already go to China. Borrowing in yuan aligns debt servicing with income streams, minimizing exposure to currency fluctuations. But the relationship deepened. The Financial Times reported that Fortescue linked the loan to its ambitions in green steel and allocated $400 million toward electric machinery purchases from Chinese manufacturer XCMG. China is no longer just a customer, it is emerging as financier, supplier, and industrial collaborator. The transformation didn't stop at the corporate level. In August 2025, Reuters revealed that a subtle yet significant regulatory update had legalized yuan-based syndicated lending within Australia, allowing participation from both Chinese and local banks. This change enabled Fortescue's financing and potentially paved the way for others. If this trend continues, it could gradually weaken the dominance of the US dollar in Australia's corporate bond and loan markets. Momentum is already visible. On September 1, 2025, the Australian Bureau of Statistics disclosed that 14% of the country's exports to China were now priced in yuan, up from just 3% the year before. The IMF followed up on September 2, estimating that if this pattern persists, Australia could reduce its need for US dollar reserves by as much as $20 billion each year. That would reshape the Reserve Bank's foreign exchange portfolio and decrease transaction-related costs. That shift was logical. According to June 2025 data from Australia's Department of Industry, over 80% of Fortescue's iron ore exports already go to China. Borrowing in yuan aligns debt servicing with income streams, minimizing exposure to currency fluctuations. But the relationship deepened. The Financial Times reported that Fortescue linked the loan to its ambitions in green steel and allocated $400 million toward electric machinery purchases from Chinese manufacturer XCMG. China is no longer just a customer, it is emerging as financier, supplier, and industrial collaborator. The transformation didn't stop at the corporate level. In August 2025, Reuters revealed that a subtle yet significant regulatory update had legalized yuan-based syndicated lending within Australia, allowing participation from both Chinese and local banks. This change enabled Fortescue's financing and potentially paved the way for others. If this trend continues, it could gradually weaken the dominance of the US dollar in Australia's corporate bond and loan markets. Momentum is already visible. On September 1st, 2025, the Australian Bureau of Statistics disclosed that 14% of the country's exports to China were now priced in yuan, up from just 3% the year before. The IMF followed up on September 2nd, estimating that if this pattern persists, Australia could reduce its need for US dollar reserves by as much as $20 billion each year. That would reshape the Reserve Bank's foreign exchange portfolio and decrease transaction-related costs. The country's banking ecosystem is adapting swiftly. In June 2025, ANAMP's bank announced it had rolled out yuan clearing capabilities for its corporate customers. Meanwhile, the People's Bank of China introduced a discounted clearing rate for yuan, 0.05% versus 0.25% for dollar transactions, valid for the next 3 years. This isn't merely a discount, it's a strategic incentive to accelerate global yuan integration. Australian firms are taking notice. Executives are transparent about their motivations. A senior figure in the mining sector told the Financial Times on September 2nd that transitioning procurement deals into yuan helps mitigate exchange rate volatility and decreases dependency on American financial institutions. Paired with Fortescue's near-governmental loan terms, the trajectory is becoming evident. Australia's largest private enterprises are experimenting with a system where China serves not only as buyer, but as underwriter, manufacturer, and infrastructure provider. The public sector is moving in tandem. On September 1st, the Reserve Bank of Australia announced that yuan now accounts for a quarter of its foreign reserves, up dramatically from just 5% in mid-2024. Central banks typically adjust reserve allocations gradually, but Australia's pivot has been swift. According to the IMF's September 2nd report, central banks across the Asia-Pacific increased yuan holdings by an average of 40% year over year, but Australia is outpacing them all. This transition invites deeper concerns. If a longtime U.S. ally expands its yuan reserves fivefold in less than 2 years, what are the implications for its access to emergency U.S. dollar liquidity, such as Federal Reserve swap lines? A policy brief from the Lowy Institute on September 2nd warned that over-diversification of reserves could partially detach Australia from dollar-based global financial safety nets. What's unfolding is not merely economic pragmatism, it's a fundamental recalibration. Australia isn't just strengthening ties with China in trade. It's steadily re-engineering its financial architecture, drawing capital, technology, and systemic support from Beijing rather than Washington. Australian Treasury representatives argue that what's taking place is risk management, not geopolitical allegiance, though the distinction is becoming increasingly subtle. Signs of diplomatic friction are already appearing. On September 3rd, the Financial Times disclosed a leaked communication from Australia's embassy in Washington, stating that U.S. officials are attentively observing yuan-denominated bond activity in Sydney with escalating apprehension. The wording implies that, from Washington's perspective, this is not simply harmless diversification, it is being perceived as a potential strategic redirection. Concurrently, institutions within Australia are integrating the yuan into their financial frameworks. On the same date, the Australian Prudential Regulation Authority issued a consultation document assessing new protocols for domestic banks to maintain yuan clearing accounts. Meanwhile, the Future Fund, Australia's sovereign investment vehicle, announced its intent to allocate as much as 10% of its portfolio to yuan-denominated assets beginning with the next fiscal period. Just days prior, on August 31st, the country's largest retirement fund launched a yuan-based infrastructure lending platform aimed at developments such as China's Beijing green hydrogen facility, signaling deeper cross-border financial interlinking. Trade-related data highlights the pace of this evolution. On September 1st, the Foreign Investment Review Board verified that 80% of direct investment from China into Australia during the initial half of 2025 was transacted in yuan, with incoming capital up 12% year over year. Bloomberg's foreign exchange metrics revealed that AUD-CNY trading volume doubled over a 3-month span, reaching $2 billion per day by late August. Financial strategists now associate a 15% drop in AUD-USD volatility over the same timeframe with increased reliance on yuan settlements. The budgetary consequences are substantial. Federal financial documents released on September 1st estimated that yuan-denominated funding led to savings of $200 million Australian dollars in interest costs throughout 2025, real quantifiable benefits for taxpayers and public financing. Momentum is simultaneously building across the private sector. On September 3rd, an Australian investment group announced intentions to issue its first green bond in yuan-based early 2026, targeting both Hong Kong and Sydney-based investors. This development extends the process of de-dollarization from government and trade sectors into private capital markets. According to the People's Bank of China, by the end of August, trade between China and Australia settled in yuan had already surpassed $50 billion in the first 7 months of 2025, overtaking the entire total from 2022. This isn't a theoretical shift. It's actively reshaping operations across corporations, reserve management, and trade documentation. Fortescue's loan is just a singular example within a broader reconfiguration, as Australian entities realign their monetary infrastructure more closely with China. Whether this is considered strategic hedging or growing economic reliance remains up for debate, but the indicators are clear and measurable. In early September, Bloomberg reported that the Port of Newcastle, Australia's primary coal export terminal, completed its inaugural yuan-settled shipment to Guangdong, valued at $820 million Australian dollars. Port administrators described the process as more efficient than traditional dollar invoicing. A few days later, Reuters disclosed that BHP, the globe's largest mining enterprise, had entered into a memorandum of understanding with the Bank of China to explore yuan-based financing for upcoming copper initiatives, noting expectations of a 4% rise in Chinese copper consumption in 2026. Australia's financial ecosystem is evolving in parallel. The Australian Stock Exchange confirmed it will begin offering yuan-denominated bond listings in October 2025, enabling local businesses to engage Chinese investors directly. This move follows data from the Financial Times showing a 34% increase in global yuan bond issuance during the first half of 2025, with Australia emerging as a prominent new participant. Policy frameworks are adjusting rapidly in response. On September 4th, the Australian Treasury included yuan borrowings in its official sovereign funding strategy for the first time, an unprecedented elevation of non-dollar debt. Simultaneously, the IMF noted in its September 2025 regional outlook that, should this trajectory persist, the share of US dollars in Australia's foreign reserves could decline below 40% within 2 years, positioning the country among the most currency-diversified developed nations. This leads to a critical and unresolved issue. If the yuan becomes this deeply embedded within Australia's monetary landscape, can the US dollar realistically reclaim its historical dominance? The narrative doesn't conclude with finality, but with a figure that reshapes the conversation. Over $50 billion in bilateral trade settled in yuan within just 7 months, eclipsing totals from the prior 2 years combined. If this rate of adoption continues, the real question becomes, how much longer will the US dollar remain Australia's default currency for global commerce?